First up, the macroeconomic environment and changes in company fundamentals could compel investors to hold cash. Mike Suku, head of retail and institutional business at Foord, joins us from our Cape Town studios to discuss their approach to handling risk and volatility in the current environment, as well as the performance of their funds over the last 3 years, despite all the doom and gloom. And let's start right there, Mike, because the performance over the last 3 years has been outstanding. How are you managing to achieve traction in, as you've stated, what can be seen as an environment of doom and gloom?
I think, thanks, Bronwyn. Good evening. Nice to be here again. I think that is the point. You know, I think even if you could look at over 10 years, if you invested in just a decent balanced fund, you're going to get 18% per annum, with inflation at 6% per annum. So you've done amazingly well. You've grown your wealth in real terms. And particularly over the last 3 years, with all the doomsayers around, with all this negativeness around, it was either we had the tsunami in Japan a couple of years ago. We've been having talk about one of the countries falling out of the Eurozone, whether it was Greece, and then the contagion effect that would have with the other countries there. Then towards the end of last year, the worry about the fiscal cliff and what was going to happen when taxes were increased and what was going to happen when there were spending cuts. Was this going to pull America back into a recession? So with all these fears that have been out there over the last 3 years, the performance, if you had just stayed with your plan, has been outstanding. If you're in a balanced fund, you would have returned over 18% per annum. In an equity fund like our equity fund, we got 23% per annum. So very, very good returns in this kind of uncertain environment.
And crucial, Mike, to that balanced fund philosophy is not to have all your eggs in one basket. Would you say that is fundamental to your whole thinking?
I think so. I think that's really how Foord position ourselves. None of us know the future, so we try and always keep that balance. In those 3 years, we've had times when the rand has strengthened, we've had times when the rand has weakened, and it's really just trying to get that balance. And I think that's what we try and do, and that's why we manage to give our investors the good absolute returns year after year.
I had the opportunity to have a discussion with Nouriel Roubini, the famed economist, or also known as Dr. Doom. He says he actually likes to be known as Dr. Reality rather than Dr. Doom. But I asked him about his forecast going forward from a macroeconomic perspective, and pretty much as can be expected, he said it was a mixed bag. Is that in line with your thinking at this time?
You know, Bronwyn, we think that this global economy, there is a synchronized recovery taking place. And I think what people forget, when you have a balance sheet recession like we had in 2008, 2009, it really hurts investors and governments alike. So it takes a long time to get out of that. You first have to deleverage before you can start spending and getting this money circulating in the economy again. So it takes time. And I think that was it. People weren't giving this time for this economy to recover. So we're quite bullish going forward. We think that America, the biggest economy in the world, is recovering nicely. We think that house prices have increased nicely. People are gaining some confidence there.
Mike,
by the latter part of this year, we think.
Before we move on from the US, and I'm sorry to interrupt your train of thought there, but this whole debacle around the pulling out of this excess liquidity from the system, the removing of the quantitative easing, down the line, that has to happen. How do you feel about that, and what impact it will have on the US?
I think, we view it as a positive, because Bernanke would only withdraw that stimulus if he feels very confident that that economy is on a sustainable growth path. I mean, he's very aware that if he withdraws it too soon and they go back into recession, it's almost going to be impossible to get them out of that. So when we look at it, the numbers that we've seen as well, there is job creation coming through, there is property prices going up. The wealth of America, that the total household wealth in America is $70 trillion and growing all the time. So they're a wealthy country. He's seen what's happening, and he's deciding before this money gets out of hand and inflation starts creeping in, let me start withdrawing this. So we think he's got things under control. He said that he's not going to raise interest rates for a long, long time. He's targeting unemployment of 6.5%, and that's still probably 2 or 3 years away. So you're going to have the biggest economy in the world with negative real interest rates probably for a long time. and we think this economy is going to recover nicely.
What about China? Soft landing, hard landing, to go back to the old debate.
Well, we think soft landing. You know, we've been saying for a while now, we think China, remember that base has got bigger, so you can't expect it to be growing at 8, 9, 10% per annum anymore.
So the second quarter GDP number at 7.5% out today.
That's right. So that's in line with what we're saying. We're saying that they can grow between 7 and 7.5% probably for the next couple of years. After that, they'll probably go between 6.5 and 7% as that base gets bigger. But we think that's very positive. We think the consumer is becoming more a factor in that economy. It's not reliant on infrastructure spend. And as these 20 million people are urbanized every year, as they come into the cities, there are jobs available, there's good salary increases, and they want to have nice clothes, they want to have watches, they want to have cars, and we think that that is a sustainable for certainly the next decade. So China doesn't worry us. We think soft landing, which is just natural as this economy grows.
What about Japan as a risk to the global economy? Where do you stand on that discussion?
Well, look, Japan is trying to stimulate. That's very much a wild card. We don't really know if it's going to succeed. But they pump in $65 billion a month into that economy. They want to get out of this deflationary environment that they've been in for a long time. So it is an experiment, and none of us know how this is going to unfold in time. But they're the third biggest economy in the world. So imagine if you've got the US, the biggest recovering, China doing okay, and then Japan can come to the party as well as the third biggest economy. That's really reason to be quite positive about this global economy.
But what if Japan doesn't pan out as a positive story? You've just pointed out that it's the third biggest economy in the world. Wouldn't that have serious ramifications for global economic growth?
We don't think for global economic growth. Japan has been a non-performer, even though, as you say, I mean, as I said, it's the third biggest economy in the world, but they have been slipping slowly over the last few decades, or last 2 decades. So if the experiment doesn't work, they'll probably just keep moving into deflation. It's an environment that, funny enough, the population are quite happy with, because there are a lot of retired people there. They've got high personal wealth. So slight deflation actually suits them. Things are getting cheaper for them. So the population will be unaffected, and we don't think it'll have too much of an effect on the global economy, because we even think Europe will start bottoming, stop contracting by the last quarter of this year, probably a bit of an uptick early next year. It is going to be a very slow recovery, but Europe probably bottoming, and as I say, the other economy is looking quite good.
What about other emerging markets beyond China? Nouriel Roubini of the opinion that we're going to see emerging markets underperform, potentially disappointing across the board, whereas, as you've alluded to, the developed world will start to recover. Your thoughts on the broader emerging market group?
I think they're still going to be all right, Bronwyn. I think what's happened now, we've seen quite a knee-jerk reaction. So as the US economy started recovering, Bernanke signaled that he's going to start tapering. People got very nervous, got out of emerging markets. Bond yields shot up. Money moved back into the developed world. But I think when things settle, and as commodity prices settle, and as currencies settle, we'll have this synchronized growth. Because even as far as South Africa is concerned, if Europe starts picking up, a lot of our exports go to Europe. Maybe the rand at 10 to 10.5 helps our manufacturers. It maybe competes with the imports that are coming in. Eventually we can export. So it might even help our current account deficit, lift us up a bit. So I think in time there has been a bit of an overreaction. But I think things settle down, and I think as the US, and the US is very important because they're the biggest consumers in the world, they are going to be the driver of this growth. But I think as they recover, Europe have got a market to export to, they start recovering slowly, China's still there, and the emerging markets will start settling, and they will do okay as well.
Mike, we've got 2 minutes left of discussion. Just coming back to the balanced fund and the outstanding performance across many, many years. Let's just focus on your equity exposure and what stock specifically you are holding at the moment in that balanced fund. Your biggest holdings. I mean, I don't want you to go through to all the detail.
Okay, so again, it's the balance. You try and get the balance. So we'll have Billiton. We bulls on the global economy, so we'll have Billiton as our number 1 holding. We've got Aspen in there as well. We really like them. We like management. We like their plans and what they're doing going forward. We've got things like SAB and British Tobacco as our non-commodity rand hedges. Richmond is also in the top 5. And then we've also got our 2 banks, Standard Bank and RMB. So it's just trying to get that balance right. But we really try and stay with quality companies where we've got some predictability in earnings, where we can see these earnings for 3 years down the line are going to be predictable, good balance sheets, good cash flows, good dividend yields. Those are the type of companies we want to hold.